Hi, welcome back. Today is Tip Tuesday. Today, we're going to talk about supplemental property taxes. It's probably a term that you might not have heard of. I know personally it's a term we don't talk about enough. So it's a section in the contract and also in the disclosures that explains supplemental taxes, but it tends to be overlooked and not explained to the buyers. So that's why we're doing this Tip Tuesday. So what is supplemental taxes? What ends up happening is once you close escrow, you will end up getting a letter from the tax assessor's office and a bill. And you're like, why am I getting a bill? My taxes are included in my payment. If you got financing, that's how your payment is structured, is your property taxes are included in your mortgage payment, right? Up here, I'm including a description of what I'm talking about. So you purchased this home for $485,000. In Monterey County, the estimated tax rate is 1.25% of the sales price. You times 1.25% times your purchase price of $485,000. You could estimate that your property taxes are going to be around $6,062.50 per year. And your taxes are due twice a year. The way that I always remember when property taxes are due is no darn fooling around. They're due in November, they're late in December. That's the first payment. And then they're due in February and they're late in April. So your taxes are due in November and February. When your property taxes are included in your mortgage, you pay a little bit every month. Your lender holds an escrow account and those funds are sent to the assessor's office to keep your taxes current. So the supplemental tax is based off of the seller's property taxes. So let's say, for example, the seller purchased the property for $250,000 times 1.25%. That gives the seller's tax base $3,125 per year. That's a difference of $2,937.50, a difference between your tax base and the seller's tax base. So when escrow closes, they have to close what's recorded on the property, what's a matter of record. And because the seller's taxes is what's recorded on the property, that's what they have to do. All their prorations at closing is based on the seller's tax rate. Once the property records and the assessor's office gets caught up, they're like, hey, wait a second, Mr. and Mrs. Byers should have paid this amount. The proration should have been based off of $6,062.50. So then what they do is they make a calculation and then they send you a supplemental tax bill. Basically, the property is being reassessed. So it's very common between 30 and 120 days that you will get a supplemental tax bill from the assessor's office. It's all based on the difference from your taxes and the seller's tax base and the prorations of when you closed. It's not going to be for the full year because remember, taxes are paid twice a year. So it would just be a portion. Depending on the sales price or depending on how much the seller's tax base was, it could be pretty hefty. I've seen supplemental taxes be upwards of $3,000. Now, I do know for a fact the assessor's office will make payment arrangements. So I know that was really confusing, but I hope it was good information. And I want to thank you for tuning in. If you like what you see, please hit the like button and also subscribe to our channel. We post these every Tuesday. We're trying to give as much information as we can to you. We like to incite, empower, and educate. Thanks again. See you next Tuesday.